In this lesson, you're going to learn how to complete the first step of our income statement projection model for Apple, which is to look at some of their historical numbers, ratios, and growth percentages, and then figure out how to use those when making our 5-year projections that you see over here on the right side of the page. Now, whenever you think about a company's income statement, there are a couple of key items that you have to project. The first one is revenue. And with any kind of model that you have, no matter how complex it is, everything else in your model is going to, in effect, flow from revenue. So even if you have a really complex model, far more so than what you see here, it's for a real company with 25 different divisions, all the expenses, everything on the balance sheet, a lot of the items on the cash flow statement are still going to flow from revenue. So that's the first and most important item that you have to get right. The next items on the income statement are expenses. So you have cost of goods sold for most companies, then you have operating expenses. Here, research development and selling general and administrative expenses. So you have to get those right as well. And as we'll see, there are a couple different ways you could do it, but on the income statement, really the most important items are revenue and expenses, simply put. Now you do see some other items here, so depreciation and amortization, stock-based compensation. These are other types of expenses. But overall, for most projection models, these are less important than getting the revenue and operating expense and cost of goods sold expense side correct. Then moving down here, we have interest income, interest expense, and then other income and expense. These are all going to be coming in from other statements. So we're going to have to look at the cash and debt balances on the balance sheet specifically before we get to these. But these will also be important for our income statement, but they're just not something that we're going to address here because they depend on other statements. And then the items here at the bottom, income tax provision. This is actually very, very simple, and you usually just pick a standard rate here to make your projections. And then earnings per share and diluted shares outstanding, again, pretty simple. You usually make some very, very simple assumptions here. So really for the income statement, the main important items are revenue, cost of goods sold, and then operating expenses. So those are the ones that we're going to focus on here. Now, when you're projecting the revenue and expenses for a company, you have two choices. So there are two ways to make these projections. I'm going to start with the revenue side first. On the revenue side, you can either make a simple percentage growth assumption, and as you can see, that's the approach that we're taking here. Or if you want to be more detailed, you can do a unit by unit revenue build. So the difference here is that with a simple percentage growth assumption, we're just saying that revenue is going to grow by 10% or 5% or 8% per year, and that's it. Whereas if we have a unit by unit revenue build, in the case of Apple, for example, we would say, okay, they're going to sell X number of laptops, they're going to sell X number of iPhones, iPods, and iPads. We could add in all their other products here. These are just the main ones that I'm focusing on. And then we'd assign a number of units sold to each of these, and then an average price. And we would just multiply these. We take the units sold times the average price and get the dollar amount for each of their different product lines, and then sum everything here up, and then that would be our revenue. So that's how you do a unit by unit revenue build. We're not going to worry about that here because you don't need to know that for the purposes of interviews unless you have some kind of experience working on this before, but it's actually fairly simple. If you want more on that or more detail on any of this really, you can take a look at the advanced modeling course, which focuses on a case study of Microsoft and Yahoo. So you can take a look at that if you want more detail. But for our purposes, we're just going to go with simple percentage growth assumptions because we're focused on what you need for interviews here. Now for the expense percentage assumptions, again, there are really two ways you can do it. You can do a simple percent of revenue assumption, or you can do an employee build. Now the simple percent of revenue assumption is what you see right here. We're assuming that each one of these comprises a certain percent of our revenue. And then we just carry this across, we make some adjustments to this, we might take an average of this to figure out what it's going to be in future years. And that works very well for most companies. And a lot of equity research analysts also do the same thing when they're making their own projections. So this one works well most of the time, and especially when you're in a time crunch, when we're working on a model for an interview or for a case study or something like that, that's fine. If you want to get more detailed, what you could say is that you have cost of goods sold employees, you have R&D employees, and you have SG&A employees. Each one of these employees has a salary, an average salary in this case, a bonus, benefits. And so what you do is you make an assumption, say the average salary, bonus, and benefits for each of these employee types is such and such, and then you have a number of employees, And so what you do here is you just take these first three, the salary, bonus, and benefits, you'd sum those up and multiply it by the number of employees. And then what you would do is you'd assume that the number of employees was growing by a certain amount each year. And then you'd sum up everything, and that would be your total expenses for that year. So again, it's actually not too complicated. It's really just splitting it into different components. We don't usually do this in investment banking when we're trying to make a quick model or do a quick valuation or a quick merger model or LBO model, simply because we often lack the information. Unless we're working with the company and they're our client, you really don't have enough information to do this type of thing most of the time. Again, if you want more detail on how you might approach this, even if you have limited information, check out the advanced modeling course and we go into it in more detail there. So going back to our original task now, we want to look at the revenue growth, the percentage of revenue that each of these expenses represent, and then go through and see what these historical numbers here look like. So to do this, what I'm going to do is I'm going to show you exactly how to get the numbers for 2007 first. So for COGS as a percent of revenue, I'm just going to go down using the control and down arrow key. I'm going to take cost of goods sold and divide it by revenue. And then I'm going to go down to R&D and divide that by revenue. Then I'm going to take SG&A and then divide that by revenue as well. So we have these expenses. Now for stock-based comp and depreciation and amortization, I'm going to do the same thing. So I've broken out stock-based compensation right here, divide it by revenue. And then depreciation and amortization, I will do the same thing right there and divide this by revenue. Effective cash interest rate, debt interest rate, we're going to leave those alone for right now because they're going to depend on our debt balances and we're going to have to go through the filings to get a sense of what to use for those. For the effective tax rate, all I'm going to do here is take our income tax provision and then divide by pre-tax income. So you have that. And then the rest of these are all balance sheet items or cash flow statement items, so I'm going to leave these alone for right now. So we have all that in place. And what I want to do now is copy across all the different expenses and the tax rates that we have here. So I'm just going to highlight everything with Shift Control down arrow key. That highlights everything. I'm going to press Control C to copy it. I'm going to press Shift and the right arrow key twice to highlight this whole area. And then I'm going to press Alt ESF to paste everything as formulas. Alt ESF pastes everything across as formulas. Very, very helpful whenever you have a large area like this selected. You're going to be using Alt ESF all the time in investment banking. And it's one of the most useful shortcut keys, and you're going to be using it a lot in this projection model as well. For the revenue growth, if you look at the formula, this is hard-coded in because I've just taken this number for 2006 from the filings. What I'm going to do here is just take the revenue growth for 2008 and divide by the 07 number right here. Subtract 1 to get the percentage growth. I'm going to take this, Control C, and then Alt ESF to paste this across. So with all this in place now, we have a sense of what Apple's historical numbers here look like. We see that with revenue growth percentages, it's really all over the place. We're going from 27% to 52% to 14%. I can tell you just from knowing Apple that this is basically because they were introducing the iPhone, a major new product line around 2007, 2008, which explains the sudden jump. Whereas in 2009, they had less in the way of new, absolutely new products. There's more upgrades. So that probably explains the lower revenue growth here. For cost of goods sold as a percent of revenue, so overall, it looks like they're becoming more profitable here. In other words, their gross profit is going up because cost of goods sold as a percent of revenue is going down. That probably reflects the fact that their manufacturing costs for iPods, iPhones, laptops, computers, and so on is going down over time. So that makes sense intuitively that the cost of goods sold is falling over time. Then for R&D and SG&A as a percent of revenue, so these are both generally falling over the past 3 years. Now, to be honest, this one's actually a little unusual, and the reason it's probably happening this way is because when we looked at this, we took out stock-based compensation. If you look at stock-based compensation here, that's actually rising. We've excluded it, which explains why these are falling, because normally with a company, you'd expect these to actually be rising, because as they earn more revenue, they need to pay for more employees, they need to raise the employees' salary. So normally you'd actually expect these to be rising or staying the same. In this case, they're actually falling, which is a little unusual, but not entirely unexpected since we've taken out stock-based compensation here. Now, stock-based compensation just refers to when a company pays an employee with options or by granting them stock or anything else like that. And overall, you expect that to also be rising over time. You expect it to be rising because they're going to have to be paying more over time. Their stock price is presumably going to rise, and it's definitely risen if we're talking about Apple here over the past 3 years. So you expect that to be rising. So this one makes sense. Depreciation and amortization. So this is referring to plants, property, and equipment and how they wear down over time. Given that a company is going to be investing in PP&E over time, you have a higher base amount. So more of that is going to be depreciating over time. So this number makes sense as well. The effective tax rate, we see it's around 30% here, 30, 31, 32%. Normally, US companies are closer to 40% here, but in Apple's case, they probably have foreign income tax credits or some kind of other arrangement with foreign subsidiaries, which lowers their effective tax rate. So that is likely what's going on here. So that's a quick overview of how you look at some of the key statistics on the historical income statement for a company like Apple. And again, there are really two ways you could do any of these numbers. For revenue and expenses, you can do a complex unit by unit build, or you could just make simple percentage growth assumptions or percentage of revenue assumptions in the case of expenses here. One thing that's important to note that I do want to point out here is that with expenses, you never assume a growth rate for the expenses. So it would be odd, for example, to see COGS percent growth. The reason you don't do this is because you want expenses to always be tied to revenue if you're doing it like this. So you're always going to use a percent revenue assumption here instead. But that's a quick overview of how you look at the historical numbers for Apple and then decide on the appropriate growth rates and percentages of revenue to be using here. What we're going to do next is actually carry this across to the other side, and we're going to be looking at what Apple might look like over these 5 years, from 2010 through 2014, and I'm going to show you how to create projections and then how to finish filling out our income statement here, and you'll get some practice filling in the numbers yourself and linking everything together.